When I was a kid, I remember learning about a stock for the first time, asking my dad some questions about it. I think I was in fifth grade. And, I asked him, like, what is a stock? And he said, it's basically, your right to owning a piece of a company and its associated income as a shareholder and profit participation. And I said, that's really cool. So, like, if I have a Microsoft stock, does Bill Gates know who I am? And my dad was like, well, no. And I was like, why not? And he was like, because you're, technically not on their books and records. So then I was like, oh, so I don't own it. He said, no, but you do own it. So then actually, when you go down this path, even as a fifth grader, you kind of just realize there's a lot of asterisks to things that you're being told about, a certain representation of what a financial asset is and it isn't. And the thing about Bitcoin that's really amazing is actually it's attacking at the core this issue of custody.
Hi, everyone. Welcome to another episode of 21st Capital. Today is January 21st. It's a very cold day, I think, at both places. And we have the privilege of talking with Jeff Park from Bitwise, head of Alpha Strategies. Very, very brilliant analyst and commentator of the Bitcoin space. I'd love to follow his account. Full of alpha, as his title suggests. Welcome, Jeff.
Thank you, Sina. Happy to be here. It is very cold today here in New York, and it sounds like by your introduction, it is cold in the South as well.
Yes. So one of the reasons I was super excited to talk to you was my coverage of ETF activities earlier last year. It feels like ages ago, but we were actually talking with the community at the level where people were thinking ETFs are just, a bunch of paper Bitcoin that are designed to short Bitcoin. So we were just trying to put out some content explaining how massive this thing is going to be. And thank you guys for being there and adding some more fuel to the fire and onboarding people. Especially Bitwise team is amazing in terms of their outreach. I've been just seeing all the events they go to, all the groundwork they do to educate Wall Street and investors about Bitcoin. This is essentially your work took us to the next level in Bitcoin. Thank you for that. Other than that, you have this fantastic thesis about portfolio construction, radical portfolio theory. So that will be the focus today, and we'd like to learn all about it, how it emerged, and especially, why you think we should completely rethink the investment approach and portfolio construction approach. So let's begin by a little bit of your introduction. Maybe tell us some background, where you did your studies and how you wound up at Bitwise and what's your role.
Sounds good. Happy to kick it off. So I actually studied biology in my undergraduate years. At the very beginning, I was pre-med, like you might expect any good Asian kid might be. Really actually interested in the academic side of the research functions, and also really loved economics because I really like math, but applied math in some sense, more than just theoretical. And so I was doing a double major and then stumbled upon Wall Street, tried healthcare investment banking as a summer analyst. Was kind of interesting, but not exactly the thing that gravitated my mind towards the thing which was just trading floor that I found most interesting, actually. So I started my career at Morgan Stanley as an exotic equity derivatives trader. Completely kind of gave up on the pre-med side of things, but I really like the capital markets. I think for me, the capital markets, as it is today, as it was back then, is maybe one of the most fascinating innovations of our times, where the greatest minds come to compete. And at the end of the day, you get a scorecard, you know exactly how to compete it. It's very fair, it's very meritocratic. And there's something about this that I think is just very exciting. So for me, being a quantitatively minded person, when I first discovered Bitcoin on the trading desk 10 plus years ago, it felt like to me, this was very important. because Bitcoin would, in a way, represent not just interesting quantitative qualities about the volatility profile, but as somebody who lived through the financial crisis at the beginning of my career in 2008, it's very easy for me to be at some level cynical about the system that we've inherited and the ways it can be challenged by something as novel and radical as Bitcoin. And so all of those things registered a little bit of light bulb for me, and I've been following the industry ever since. I joined Bitwise about 3 years ago after a long career in the hedge fund industry, focusing really on multi-strategy equities and credit solutions. And I think Bitcoin, in a way, as well as crypto, really represents a lot of the learnings that come from looking at alternative assets that can be applied in a whole new way, which is what I'm really interested by. And that's what I do at Bitwise. I'm the head of alpha strategies. We have multi-strategy, alpha-centric solutions for our institutional investors, but we also have ETFs that are tracking active trading strategies that I think will be the next hyper-financialization of Bitcoin into something a little bit more useful, uh, risk-adjusted, maybe interesting for certain select types of investors looking for something a little bit different than just passively tracking the spot exposure. And 2025, I believe, is the year that we're going to see a lot of issuers come to market, bringing what they think is actually the most valuable feature about Bitcoin and actually being able to then capitalize upon it as a useful financial product.
You just reminded me of Michael Saylor's refinery analogy. So 2025 is the year refineries will begin creating multiple layers of levels of risk, and bond like versus leverage funds like performance. So looking forward to that. I know you're also working on some of those products. Maybe we'll talk about them. Hopefully time will permit. But let's begin with your work on radical portfolio theory. I guess I want to begin asking, where does that 60/40 come from? Because I've always managed my own money essentially, because I'm like, what an advisor could do for me. I'm not gonna argue with them about my Bitcoin. So what's the point, right? I've been
Right.
most of the time for investable, 100% of my investable money has been in Bitcoin. So there has been no point of any kind of financial. So I haven't been in those circles where they, that would put me on 60/40 or something like that. But where does that come from? Is that some kind of an analysis somebody did 40 years ago and they came up at those numbers and then it was there, or is it because I have a hard time understanding how like a fixed portfolio construction can survive so many decades. But so how it appeared, and then why do you think it doesn't apply to our world today anymore?
Sure. So 60/40 is a great marketing gimmick. It's essentially capturing a few salient points that people remember by just hearing about those particular words, which is that the first point is that it's very simple. There's only two things you have to think about: equities and bond. That's very easy for people to wrap their head around. In it, they're channeling what those assets represent to you. But the second thing that they're also saying is one thing should be slightly larger than the other by having a 10% difference across the two pies and expressing a view that you should actually still position yourself for growth, which is the 60 in equities. Um, it's a neat trick. And I think it actually made a lot of sense for folks who are thinking about increasing their wealth generation by investing in some thoughtful portfolio construction. But the reality is 60/40 is actually very old. It's very dated. The reason it's somewhat irrelevant even today is that most of the institutional investors already have moved away from that construct in thinking about alternative assets and private investments that can encapsulate uncorrelated returns even from the public market. So I had a brief stint at the Harvard Endowment as well before my hedge fund career. And already within the Harvard Endowment model, you had these endowment allocation public policy portfolio concepts where equities and bond in the public format is actually fairly constrained relative to the things they're doing in the private space, like infrastructure, real estate, private equity, venture capital. and then alternative assets that are like litigation financing or reinsurance investing. There's actually a whole section that endowments and pensions are already thinking about diversifying beyond the 60/40. And the thing that's happening now is whatever you think of the SEC, and whether they're pro crypto or anti crypto or pro open market or not, the thing that has been indisputable is that the line between retail and sophisticated private institution is blurring because they're allowing more financial products to come online for accredited investor categories that historically was not available. They were really only available for the most experienced, sophisticated, well-capitalized investors. And that line is very slowly blurring. And that means actually forward looking, there's going to be a lot of opportunities for retail investors to capitalize upon that trend. And what I'm most excited about, the radical portfolio theory at a level, is that for the first time in our generation, we will have a chance to build a whole new portfolio, accessing a variety of those alternative assets in a format that is possible for anyone that historically would have been only been vanguarded by the biggest institutions and private capital.
Yeah. So you mentioned a predisposition to being cynical about the system. When I first learned about Bitcoin, I was going through a similar thought process. A lot of the traditional finance is heavily guarded and gatewayed, if that's even a word, by traditional institutions, and they're benefiting from this massively. There are mandates to do whatever you need to do in the finance realm through financial institutions, and in other words, they're kind of protected, and their customer is guaranteed. There was this analogy that someone said, being in finance is like being at the tight tight part of an hourglass where there's a lot of money going through and you just pick a little bit of it every time. So it has been, a way that the mandates or the limits we've placed on the financial industry has created this permanent captive customer for older financial institutions, where they simply have to charge a fee for their services, and they don't really have to compete. If you don't like Chase, where are you going to go? Bank of America, same thing. Wells Fargo, same thing. It's kind of like you're not getting much of a competition there, and it's by design. But this whole alternative assets, even Trump's meme coin, which kind of sounded outrageous to me, but it has another side which shows that actually we are disintermediating these institutions, and there is no barrier anymore. Anyone can go online if they have an audience. Anyone can go online and make themselves tradable 24/7 across the world. I don't know how banks will be dealing with this. I know that they will probably love to get on board. Well, they probably have thought about stopping it maybe in the past few years, but that's not possible. And that was actually one of my key issues, where when I was learning about Bitcoin, I was considering, is this thing killable? And then after some months of studying, I realized that it's a resounding no. So that's where I actually YOLO'd into Bitcoin. So without that option, these traditional institutions will probably have to join and then benefit from charging fees, continuing to charge fees on transactions. But they can add a lot of value, especially because they're regulated. They can add easy insurance. They can add a lot of financial products because they are set up for it. They're integrated with everyone else's financial activities. They can do it, but I suspect there is still regulation that's preventing it, right? The SAP 121 and probably a lot more that I don't know about. They are preventing banks from offering services. Do you think this year we can get some reprieve and maybe enable banks to custody Bitcoin or provide easy trading. It would be a game changer if you can buy Bitcoin directly in your Fidelity. Although you can buy ETFs right now, but uh, you can't really withdraw or you can deposit Bitcoin, and you can't get loans on your Bitcoin stack and so on. And I suspect once banks get into this game, that will be one of the first things they'll explore.
Yeah, there's a lot about the banking system that we know, that we take for granted, that we're taught in school about a certain way the economy works and a certain way that banking services are provided for. And if you grow up really not thinking about the entrenchment of that system, it's easy to just actually not think about it because of the ease in which we now can actually process payments, and things seem to work really well in ways that feel very good, expedient, electronic execution versus physical trading on floors. Like everything just feels like it's advancing, but that's all surface. The back end is actually still very, very, very obsolete. And the thing that crypto is doing actually is really turning upside down some of the most fundamental assumptions we have taken for granted in the system. For example, when I was a kid, I remember learning about a stock for the first time, asking my dad some questions about it. I think I was in fifth grade. And, I asked him, like, what is a stock? And he said, it's basically, your right to owning a piece of a company and its associated income as a shareholder and profit participation. And I said, that's really cool. So, like, if I have a Microsoft stock, like, does Bill Gates know who I am? And my dad was like, well, no. And I was like, why not? And he was like, because you're, technically not on their books and records. So then I was like, oh, so I don't own it. He said, no, but you do own it. So then actually, when you go down this path, even as a fifth grader, you kind of just realize there's a lot of asterisks to things that you're being told about the certain representation of what a financial asset is and it isn't. And the thing about Bitcoin that's really amazing is actually it's attacking at the core this issue of custody. The example I just shared you with Microsoft, where you have an intermediator as a custodian who actually is the holder on the books and records, there's a lot of benefits that come from it, of course. It makes settlement easier, it makes clearing easier, it makes fraud probably less prevalent in the ways that protects consumers. But in the end, you actually don't own it. And Bitcoin is the thing that really turns the custody model upside down. There's risks actually that come with this too, which is a risk that I don't know if everyone in the world is ready for. But at the same time, it's a new way to think about a financial primitive. And I think that's the exciting thing about crypto and why regulators are so concerned about the ways in which there seems to be a lot of obfuscation and a lot of stoplights along the path. But the reality is, it's really attacking the core, the social contract of the banking model, which is custody. Uh, that of course has implications for lending, as you've called out on. There's implications for that on derivatives that exist on top of the ownership of those assets. But let me tell you something about Bitcoin ETFs in ways that I think has been a great product market fit for a variety of investors. There are a lot of people who still want to own Bitcoin, but they don't want to have the worry and the insurance of thinking about custody. And this is a very much a human thing. Humans have lots of other things they need to focus on that they have 99% of the mind share on. They do not want to deal with self custody if they feel that this is not value add to them. And the Bitcoin ETF actually is a thing that helps bridge this gap. And the beautiful thing is, because it fits into the regulated system, you can actually now lend Bitcoin through the stock lending program as it exists in the regulated markets without counterparty risk. So actually, there are positive EV features about the Bitcoin ETF that Bitcoin actually still may not be able to compete with. The amount of liquidity that the ETFs can draw because of the social contract that exists in that model creates all kinds of things possible without it being yet possible in native Bitcoin. Now, of course, the trend of DeFi and all the things we're imagining is that we'll find that parallel track to succeed. But there are a lot of people who still want to own Bitcoin in their regulated accounts. They want it in their tax advantage IRAs. They want it in their Roth IRAs. And they want it to play nicely with their financial advisors. and they want it to be represented in a broker statement that looks with other multi-asset portfolios. So there's a lot of benefits to having crypto plug into the traditional system, all the same in the ways that it brings and onboards new adoptions and new utilities for the traditional system.
Do you think if banks provide custody services, would that hurt the ETF model? Although it seems like there's infinite demand for the ETFs, but how do you think about like new competition coming online at Bitwise?
No, it's great for ETF issuers because we leverage the relationship and the services provided by custodians. And nothing would be better than having competition at that level, whether it's because they're bringing better technology or better pricing or better client servicing. You need competition. And actually, we want more custodians to come into the space, like a Bank of New York Mellon. We need State Street. We need the folks who actually have uh, some market share and understanding how the system works from a different lens than just being crypto native only. It's not that crypto native is not valuable, of course it is, but there is a whole system that comes with those players as well into it. And that is actually the low-hanging fruits of 2025. People talk about all this excitement about the things that Trump is going to do to push crypto as a top national priority agenda. But I look back and I actually think, you know what? Trump really doesn't have to even do very much. He just needs to get out of the way
Yes.
of not blocking paths to innovating and that's actually the lowest hanging fruit possible. Like SAB 121 is something that is so easy and bipartisan to thinking about its removal. It's actually not even pro crypto. It's just pro like good administrative policies and rulemaking first and foremost. So it's not even a crypto issue, as I like to tell people. And
Perfectly
so,
matched his agenda as well.
yeah,
Deregulation,
and
simplification, yeah.
absolutely, absolutely. And the private fund advisor rules, similar sentiment that I share is that the necessity of having a qualified custodian to offer these services as an RIA that's SEC registered is a virtuous one, but one that creates a lot of different friction points for investors outside of even crypto too. Because the reality is most private assets are not administered in having a custodian model to begin with, right? If you invest in venture company, for example, there's no custodian that intermediates the representation of those assets. Most private assets don't actually even have that concept. Now, they're also exempt because they're offered in a different exemption of offerings, securities offerings. But my point is that there are ways to bridge the gap in ways that are not so onerous to the progress of alternative assets as a whole, including crypto.
Exactly. Absolutely. All right. So uh, go back to our discussion of the traditional model having flaws, including the 60/40, the dated 60/40, which is a nice way to destroy wealth. But what are your thoughts in terms of what instead, what should come about to replace it? How better can we construct our portfolios?
Yeah. So the first thing you have to do is understand what is wrong with 60/40, because without understanding it, you can't possibly conceptualize and grasp the future in the ways to protect yourself. So at the core of the 60/40, the number one problem is that bonds and equities, which were meant to be diversifying assets to each other, is actually no longer performing in that manner. Over the last 3 years, the monthly correlation between US equities and bonds is now at an all-time high. And it is at a level that would throw anyone who thought about 60/40 as a diversification strategy uh, upside down. And you might say, actually, this is just a moment in time. It'll come back where they're going to be negative correlated again. And that's also possible. But the reality is, there are more signs showing the way that that won't be the case. The reason is very easy to understand. At some point, equities used to represent growth in a way that meant productivity gains, and it meant technological advancement and real, you know, the ungraspable gains of advancement uh, that are productive. Over time, I would say that's changed. there are elements of equities that show this, but there's also a lot of elements of equities that is being benchmarked against inflation. That it's actually just an inflation basket hedge. It's basically a way to thinking about being on track with the monetary debasement that is happening in the system. And a lot of it is because the growth model changed. Once upon a time, there really was a drive for productivity in whether it's profit maximization or revenue growth. But nowadays, what you see with a lot of companies that are public listed is there's financial manipulation that show growth in a specific way that investors care about. So things like share buybacks is a kind of a growth, I would say, that isn't super productive. Like, yes, it increases the ROE, but it's not really creating productivity growth of a country or labor or capital.
It's more like
Uh,
marketing for more capital, you know.
yes, yeah, yeah, and you almost see that in the way like the GDP model itself is flawed in the sense that there's of course consumption, which is the thing that I think about private consumption driving growth, but there's also the giant G, which is government expenditure that drives growth, quote unquote. And that's actually the biggest component these days. If you think about relatively how outsized it is that drives a country's growth trajectory. And that's you see it in the reflection of our debt to GDP ratio that it's insatiably growing. This idea of fiscal led growth by government spending. And that means ultimately equities and bonds, they're kind of converging because they represent similar discount models to thinking about the default risk of a country and the interest rate and the risk you're willing to tolerate for some duration of a period of time, and whether you want to be a lender to that sovereign. And so that fiscal dominance is actually the core thing that is merging equities and bond.
Exactly.
And it
That's what I was trying to understand. Like, what's the root cause of this? What I have had in mind is that because exactly like you said, so much government spending and the money supply expansion has kind of killed that balancing act that equities and bonds have been playing in the times of growth. Equities will grow, and then you when it's overextended, you rebalance, put some of that money back in bonds, and then at times of the economic slowdown, bonds become more attractive, so capital flows in there, and then your rebalancing proves very successful. So you begin growing your wealth in the bond sector, and the economy goes back and forth between these two states, and you just win all the time. Especially the negative correlation would help you to have a stable return too. But when there's so much cash flowing around and everything is getting pumped, well, these two also just becomes derivatives of money supply expansion. So if that's the case, well, what if you try to own other assets as well that do a better job protecting against money supply expansion? Is that a good way to think about what's happening?
Yeah, I think that's right. The reality is that the whole world now is on some kind of a giant global carry trade, and it is all based on US rates and dollar strength. And it impacts everybody. It impacts China, Japan, and Europe. It's never been more interconnected as a world than it ever has been than now. And so it's actually all kinds of games that are happening at the macro level between these cross-border flows and how they're exerting influences on the competing priorities of foreign policy and domestic policy as it relates to their economic power, right? The US is in the most difficult position because of the fact that the dollar is the reserve currency of the world, that they actually don't have the freedom to pursue a domestic policy maximizing strategy because it interferes with actually their foreign maximization policy as well, foreign policy maximization strategies as well. And these things are becoming more obviously known in the way that everything has become hyper financialized. Like when Japan raised rates by 15 bips or whatever it was that last summer, and the world just could not handle the possibility of something like that because Japan is the ultimate funder of everything that is happening in the growth model for the US, shows you that actually these are all related. And so 60/40 might sound like it's two different things, but they're becoming 100 of something. And the goal for you and me and a whole new class of young investors is to find the thing that is not part of that at all. Like get out of that global carry system, period. Because that's actually where the uncorrelated returns are going to be. The things that's not affected by these cross capital flows that are driven by actually sovereign behavior now more so than actually private sector led behavior. And so that's the interest of the 40% I'm always speaking through in the radical portfolio theory. I think about it 60 compliance assets and 40 resistance assets. So everything in the compliance assets is the things we know: public private equity, bonds, even venture capital, any of those things, I would put it in compliance assets. It plays nicely within financial models that we can model and know of. The 40 is actually more about esoteric alternative assets that haven't been institutionalized at a level yet to be participating in that giant global carry trade. Bitcoin is one of them. But there's also a lot of other things that crypto as an ethos, I think, brings upon that display the power of those strengths behind it. So another example I often cite are advancements like Polymarket. Like if you think about what Polymarket is, in that it is essentially a decentralized market to show you different kinds of odds that can exist that people want to bet on. It's a testament to the fact that gambling at some level is in many ways a, a productive endeavor for those who have the information and capabilities, right? So the thing about like meme coin trading and Bitcoin, even though they feel like sometimes they're adversarial, like you'll find a lot of Bitcoiners that are like, oh, meme coin trading, their shit coins are bad. It's bad for Bitcoin's energy, and then vice versa. There's actually more alignment there than people think. The reason is they believe in the same underlying philosophy, which is that that individual freedom should triumph all, that everyone should do what they want to do. And in a way, gambling is a fundamental human right, right? Because what I want to do with my assets and how I engage someone else to do it with is a private right. And in a way, you'll see that full spectrum of gambling as those who believe like everything is good about it. And on the other end, like everything's bad about it. We must ban Las Vegas. We must ban, gambling, period. But the truth is, it's probably somewhere in the middle. And meme coin trading is almost an expression of a new class of investors coming out, trying to emphasize on the profit opportunity that could be possible for those that are able to navigate this new meta.
Yeah, I put out a tweet. I was just surprised after this Trump coin and Melania coin stuff, and then I've been thinking about what's happening for a few days, and I think I reached a conclusion that, well, this is not going to stop anytime soon. And then this has actually shown the world that everyone can come up with a meme coin. And previously, Ethereum and other chains were just trying to say we are actually inventing some sophisticated technology, something better than Bitcoin, something I don't know, which they've been promising for many years. And the focus was on technological advancement and innovation. But a meme coin is absolutely honest. It markets itself as nothing other than a name and a community. So it's basically, and it kind of strips away all that complexity and shows us, hey, there's demand for good old gambling. And this kind of gambling is also a little bit more kind of, it has different tastes. You're gambling on someone you like, I suppose, right? So if you're a Trump fan, you probably like his coin a lot more. And it showed me that, well, there's a new business model in town, right? Anyone that reaches fame previously had to go through many other channels to monetize that fame, right? Get advertisement, partner with some advertisement company or brand companies to monetize that fame. But now everyone can spin up their own coin and have it multiply their net worth over hours. Of course, this is going to be very volatile, and I think many of these coins, because they don't have an inherent productivity in them, they will end up either going to zero or trading at some flatline level as soon as that person's attraction goes down in the public sphere. Nevertheless, I like the idea that you can disintermediate the whole system with 24 hours of coding. So you can get yourself to corners of a small village back in Malaysia, and people there could begin funding you. There might be some good things that come out of it, in terms of having access to no financial resources. If people are interested in a cause, being able to open it up for the whole world to fund it, it has value. And
Yeah, I mean, there's a few things I feel like that people misunderstand about meme coin trading. The first is that they think it's pure gambling, like playing slot machines, truly the kinds of gambling that's mindless, where, it's an addiction and the whole thing is just negative EV and you really shouldn't do it. Like casinos, there's a spectrum of games they offer, right? But slot machines as a category is probably one of the worst kinds of gambling because it really is not one in which you can apply a skill. On the other hand, you have games like poker, which actually is entirely about a game of skill, and it is fun, and there's something as that emerges out of the social capital of certain players. Maybe they even found happiness with their friends to play games, and there's something about that that's useful. And meme coin trading is actually both. It's very social. So there are people who get utilities out of this, and that there's a price for that. It's almost like a consumption good. You pay money to have fun. Meme coin trading, you pay money to have fun. Two is this idea that it's like gambling without like any notion of skills. And you could be so far from the truth by that statement, because meme coin trading is actually one of the most skilled things that exist at every level possible. Like if you're a very good meme coin trader, you're probably a very good programmer, and you have great technical capabilities because you need actually to know how to navigate blockchain latency. You need to actually set up bots that can trade effectively. You have to monitor multiple pools. You have to find liquidity in a multi-pooled way that is developing in front of you that no one's going to give you the guidelines for. So actually, they're technically super capable people. They're like engineers, and of course they're going to outcompete somebody who is just like sitting at their couch and buying a coin because they feel like they like Donald Trump. Like that's not the point. The point is that there's levels to people's expertise, just like there's expertise and levels in any financial capital markets. And so then the third thing that people will bring up is, well, there's too much information asymmetry, right? Like some people are just being taken advantage of and they don't even know it. And there's so many insiders that are just like dumping on these things and creates weird incentives and it's perverse and yada, yada, yada. That may very well be true also. But the reality is, if you take a step back and squint your eyes really hard, that already exists at some level across many, many assets that we trade in the regulated world. As much as I hate to say it, the reality is, if you think about SPACs, for example, and how obscure the SPAC market is, and the economics that come out of the original promoters of the SPAC vehicle, and how they don't even disclose it, actually. And this is an SEC registered vehicle, approved listing. Those things already show you that at some level, information asymmetry is in some way a way of life. Now, the beautiful thing is actually with meme coins, you can see it. You could literally go check the wallets and see, wow, this looks horribly set up. Man, these insiders are greedy AF. You can't even do that with SPACs. You can't even do that with CLO equity issuances. You have no idea what's happening behind the scenes about the monetization of that exact information asymmetry. And yet we permit this, and billions of dollars trade in regulated markets with this. So I look back at all of those people and tell them, you can't be so harsh on meme coin trading without first realizing how bad it is out there in the regulated markets for information asymmetry. Now, securities law insists that there is inside information, material non-public information, all very true. Let's step out of securities. What about the commodities market? What about the FX market? Those aren't securities. You don't, but there are inside information to all these markets too. There are ways that the oil market moves based on things you might know about certain things that are happening, and that could be an edge in itself. And there's no regulation to stop that. You can't.
It's
Information
actually,
asymmetry
in some
exists.
cases, in some cases, it's actually regulated and protected. The rents that they can achieve. Like a very simple example that most people have probably experienced is the housing market. When COVID caused all the mayhem, and the Fed panicked, they killed the interest rates, drew it down to zero, and at that point, many institutions were able to get super low rates, 2%, even less than that. In our area, there was this company, Invitation Homes, where was buying whole blocks of neighborhoods. And that's when even regular people were not able to access that kind of rate. It was free money. And right now, with interest rates at 8, 9, and so forth, any institution that got access to that capital and they were buying houses with cash, they are doing fantastic because they don't even have to rent those houses. They simply have to sit on it. and rent is just a plus. And there's no way their house is gonna, return less than 1.5% over time, because that's just even less than the money supply expansion. So this is another, like, wherever you look at it, there is systematic unfair advantage that different folks have. So I totally hear you on that one. But you focus on a wide range of alternative assets. Tell us more about what they are. And maybe if you can even give us some insight into how to think about how to compare them. So, because it's a broad statement to say you want to own 40% alternative assets, but how can people decide among all the other alternatives, right? There's a wide range of things available.
Yeah, for sure. There's three kind of parameters I'll put around how to think about the taxonomy of these resistance assets. The first thing is how you think about scarcity value. Ultimately, things that are scarce are valuable if other people think it's valuable. And most of the things we know in the traditional compliance world, the 60% world that I'm referring to, there are things that are not truly scarce, right? So bonds are, of course, not scarce. And equities at some level are becoming less scarce because we are seeing a lot of different ways that the equity as the base layer is also becoming financialized. So for example, take NVIDIA, for example, as a stock. It's useful, it represents something, but then there's these like 2x levered NVIDIA ETFs as well. And what are they doing? They're essentially kind of doubling down on the volatility profile of a stock and financializing it. And if you thought actually volatility itself was the thing that people liked in stocks like in NVIDIA, well, now it's not super scarce because actually someone doubled it by creating this 2x levered ETF. So features about the things you look for can also be abundant. And you might then also think about venture capital in this bucket where like, yeah, AI is really thematically interesting, so I'm going to invest in it. And you think your company is scarce, but the reality is new companies will emerge. They will compete for the talent. You saw it with the Lyft war versus Uber war versus the Via war here in New York and others rideshare companies. Like they're not that scarce at the end of the day. The winners may be, but the path along it, there can be abundance. So that's all going to exist in a spectrum. And the thing in the radical resistance portfolio about resistance emphasis is that you really should try to find things that are real scarce in its fundamental nature. And that can come from the organic world, but it could also come from the labor like capital as well. Like there are certain types of investments you can make that are scarce because it's bound by nature, like farmland or Bitcoin. I would categorize in one. It could also be, very rare, works of art, master works of art that don't exist in abundance, and maybe they can't exist anymore in abundance because the artist is dead. That truly is scarce. You can also think about it from this perspective of financial assets that can't be like copy pasted. So not like the 2x levered ETF that then you might launch a 3x levered ETF. It's a little copy paste there. I'm talking about um, true financial IP that takes labor capital from human ingenuity. So litigation financing is like an example I often point towards. It's a kind of private credit because you're funding a litigation, but at the end of the day, you can't copy paste it because there's only one lawsuit. And maybe there's other kinds of lawsuits, but then you have to really find that opportunity. And so each lawsuit and each litigation is going to look different. And you can't really trade it as a basket because actually the outcome is uncorrelated to anything else but the trial merits themselves. So one legal case will not look like the next, and they're all going to have independent outcomes based on the merits of the actual lawsuit. So you can financialize this and create pools of capital, but that's still a lot more scarce than, let's say, just buying high yield bond issuances that come every 3 to 7 years off the shelf. And so that's important. The other things beyond scarcity that is actually important is being outside of the system in ways that are advantaging the frontier and the new. So that often sits in a bit of a weird kind of regulatory area that could be a little bit gray, but actually that's a lot of the times where the edge of innovation lies. So I go back to poker as something that is slightly legal, but also slightly illegal. It depends on how it's administered and how you play it. Sports betting is another one. Once upon a time, very challenging to do it at scale. Now you have DraftKings and other kinds of things that have come to market. And so the trend is you find that things that are a little bit gray do eventually kind of move more to the light. And there's a path to institutionalizing that behavior and that product. I think crypto is actually the same thing. It could look very much like it's outside the system, but eventually it will have to participate in some kind of the system with regulation. And that's where the edge is because you're early. You're there before everybody else. But the reality is the lines will merge. So a bunch of the things in the resistance asset portfolio is really anticipating ahead of that forward curve adoption. The other thing is I see the biggest abuse of the 60/40 model being that you are essentially playing this arbitrage of time value between the old and the young. So much of interest rate arbitrage is actually, in some ways, redistributing wealth across temporal generation timelines. And you need to find things where they cannot do that to you as an owner of an asset, that they can't play the game of yield curve manipulation to pull forward the spending that is rightfully yours, but to them between the old and the new. And that's the other lens to appreciate radical assets. Part of why meme coin trading, by the way, is so incredible is that, to your point, eventually it does go to zero. Many of these meme coins, right? But many stocks also go to zero too. I think something like 25% of US listed stocks eventually go to zero. But the difference is meme coins happen so fast. It is actually like making things happen so quickly that like you can't even play the arbitrage of that pass the hot potato for the next generation game. And I actually think there's a subtle but philosophically acute like kind of point that the young folks are making, which is like we're not going to play in the game of like locking up my money for 10 years because like I know what happens to my money when I lock it up for 10 years and goes into that system. You're going to steal it. And so I'm going to play in my little box where things are so fast and volatility is like 500,000% because that's the part I know you older people cannot play in. Like you actually can't come into this market at all. And so I actually think that the world is funny, but that there's some kind of reason why things happen the way they do. And if you really squint hard enough, you'll see meme coin trading is actually a wealth transfer from the old to the new. And I think there's something very beautiful and poetic about this that will maybe see some more trends of.
Yeah, you brought up a bunch of fantastic points. I love it. It seems like we need another 4 hours to discuss. You do have 4 hours, right? So, but this idea of young generation moving intentionally moving to a place where there is no competition from older people might actually have a lot of wisdom behind it. You know, whether people explicitly mention this or not. And you reminded me of this whole social media choices. Like I've heard from a lot of young people, oh, this social media is for old people. We don't want it. Just the fact that there are old people there is a negative to them. So they just want to move to some other place where it's purely for their generation. Um, a fantastic content discussion here. How do we then summarize what we've discussed so far? Um, the idea that the old way to think about portfolio is dead. It's been dead for a while. The technical reasons you might want to have a 60/40 is obsolete, and you're basically. The biggest alpha is in understanding where the world is moving outside the traditional system.
Yep.
There is one aspect to it related to anticipating regulatory move, anticipating what's on the edge of innovation and slowly getting approved and slowly getting regulated. There is another aspect, it's a social and cultural revolution that's happening. Old assets are just not exciting anymore. That's why gold has a lot of things going for it, except it's not new for people. Then you have one way I'd like to think about this is we have an ocean and we have an empty area of land, which is the alternative assets. We are seeing like this gradual leak, which can actually turn into a large flow of water from that old pond into the new smaller pond. And this is just a matter of time until this happens. Like a new world is getting monetized and it's capturing monetary value from the old world. So what I was learning from what you said is a lot of the alpha lies in understanding and anticipating these movements and these flows. How would you kind of summarize your theory, your thesis, and what would be some of the conclusions you think people would benefit from?
Yep. I would emphasize that, as you pointed out, culture capital is real. Financial capital was real, labor capital is real, but the third thing is social capital is also very real. And it's going to become more of a ballast away from the traditional system and those who are able to navigate it. And it's actually maybe the most important thing. We've just never seen it financialized the way that we are now seeing it in certain aspects of it. So that's something to pay attention to. And the other thing is, as I mentioned before, the line between qualified professional investors and retail investors is blurring. And one of the things I'm really excited about Bitwise is we're trying to ride that wave to bringing investors more options and choices to some sophisticated products that can express their investment views more intelligently and more tactically. So one, we have the Bitcoin Standard Corporation's ETF that will be launching in March. I think that is an interesting and timely and very significantly historically important product, not just for the Bitcoin community, but for those who are really trying to stay ahead of the culture capital and understanding what Bitcoin will do to corporations. It'll do the same thing that it's been doing to people, which is that companies need Bitcoin, all the reasons that we have found at the individual layer, why we find it so compelling. The other thing is we have options income strategies that are coming live in March as well, which is taking advantage of the unique features about volatility that exists in crypto and actually harvesting that and monetizing that in smart ways that can give investors a different risk-adjusted return stream that is fundamentally different than being long only. And these products are essential because they're just giving investors more financial toolkits to accessing the kinds of ways to build your own portfolio as you see it. So I'm really excited about this one too. The options income strategies are going to focus on MicroStrategy, Coinbase, and Marathon, each individual products, but all representing something important to the crypto arena and accompanied by very high levels of volatility that will help investors own their favorite long crypto equities, but with income and a lower cost basis. And over a long period of time, that should be a very valuable thing for somebody who wants to compound capital and take advantage of some path dependencies that can exist with highly volatile stocks.
This is fantastic. I've been trying to hack engineer my own options income strategy. I'll definitely look forward to what you guys do. What's next? Well, you already mentioned. I guess one of the biggest things that we'll have to keep track is some of these ETFs that you guys are planning. What's next for your book? Do you have a kind of timeline, or are you going to add more ideas, more chapters? When can people access it?
Yeah, still a work in progress. There's multiple parts of it that I want to keep adding some substance to. One, we talked a little bit about, we really have to first understand why 60/40 is broken. And there's a lot of history that needs to be imbued into that concept, and the role of Bitcoin that eventually could serve in appending that model. The other parts of it is that there's going to be more features with a quantitative output that shows you exactly empirically how better off you are by owning these assets. And you can see the numbers and you can see the Sharpe ratio and all the things that will help investors understand why it's actually so significant. For now, I have a little bit of a X community that's set up. It's called the Radical Portfolio Revolution. It's a great group of 1,200 people plus that talk about these concepts. We explore it together. We challenge each other's mental model. We try to bring new examples of resistance assets into the dialogue. And so if you're interested, please join us, and you'll be up to speed with a lot of the smartest thinkers about how they're helping rethink about that revolution too.
Fantastic. Well, you're doing amazing work. I feel that I got a much better understanding of where your head's at and what you're thinking. So I'll definitely be following your work with much more depth and anticipation. Well, thanks a lot for joining. I know you have some work after this, so I'll let you go. But let me get this promise that whenever you have time, we get another discussion about that ETF. I don't want to miss it. It's fantastic. It's going to be a game changer. So let's talk
For
about it
sure.
where that's convenient. Perfect.
For
Well, thanks
sure.
a lot. You have a fantastic rest of your day.
Sounds great. Thanks for having me, Sina. See you soon.